On the 24th of August 2016, President Uhuru Kenyatta signed into law an amendment bill to regulate the maximum interest rates that commercial banks would charge on loans and pay on deposits as well. Now, nearly 2 years on, there's been hue and cry over the adverse impact of that law. A report by the Central Bank of Kenya on the impact of interest rate capping on the Kenyan economy shows that the interest rate capping has first and foremost infringed on the independence of the central bank and complicated the conduct of monetary policy. Now, more importantly, according to the report, micro, small, and medium enterprises, which are the bedrock of our Kenyan economy, are receiving less credit from commercial banks, a situation that has impinged on economic growth and job creation, compelling the government to signal a return to market-driven interest rate setting. Now, of course, on the flip side, there is a pocket of our Kenyan economy that strongly feels that the status quo must remain and that Kenyan banks have been unscrupulous in their lending, making supernormal profits at the expense of the mwananchi. And so the question begs, has interest rate setting truly worked, for the benefit of the borrower and the depositor? What insights can policymakers and banking industry stakeholders who are with us here in the room today draw from the experiences of the last 2 years?
It is my view that why we have capping of interest rates today is because of what I would call massive policy failure. That over time, things that should have happened didn't happen. Mwai Kibaki in 2004 did not cap the interest rates, yet we were on single digit. Why? Because he went for the cause-effect relationship about the various options within the macroeconomic management of our economy that was available for him. So maybe if the right things are done, we may start to see a correction phase within our banking system. When we start having trouble in banking sector, no one is spared. We need to make banks smile and happy by removing the caps. We need to make them cry by mitigating that with very draconian measures in other policy areas. Thank you very much.
The objective, of course, for capping was that the idea was to reduce the cost of borrowing. That was one intention. The other one was to expand access to financial services. And the other one was to increase the returns on savings as the main objective of that cap. 2 years down the line, what has happened? Whether we have increased lending or access is an issue. And our analysis do point that actually it has had unintended negative consequences. To my best of my knowledge, the cap we have is draconian. It is really drastic, where I say so because ours has a ceiling and a floor. All caps in the world don't have both. We were alone when we were trying to fight Jude Jomo. But slowly and slowly, we are getting more support. I hope so, and we hope we should be able to deal with this problem. Thank you very much.
All right, thank you so much. Honorable Njomo, I'd like to start off with you. When we listen to regular Kenyans on the street, specifically maybe the ones who can access secured loans, they say this was the right move. Maybe just to start off this conversation, what did you have in mind when you proposed the bill in Parliament?
The banks had colluded, and interest rates in Kenya, I think, were the highest in the world. And people were complaining that they want to do business, but they are being charged interest rates of 18% up to even 30%. And it is quite obvious that when you have a business where you're making about 30% profit, you're in a good business. But all the profit that you make is eaten up by interest, because if you're paying 28%, then you're making 2%, that pays for your overheads and everything else. So it did not make sense at all. There were many moves to try and push the interest rates down. Central bank had also failed its duties in regulating the interest rates that were being charged. And like the CS have said, the introduction of KBRR did not have any effect because they were just marking up on the KBRR. And the whole country was in hue and cry that we cannot be able to do business. Banks are siphoning every profit that we make. Now, to add insult to injury, if you would go through the annual accounts of banks, they were making so much profit so that if you compare with other businesses, if you compare the 10 most profitable organizations in the country, 7 of them would be banks. What does that mean? That we are killing other businesses and making our banks better and more profitable. So the time had come when we had to level the playing ground, where we have to let our wananchi, our business people, our SME owners be able to get loans that are affordable. And like I had said sometimes before, in that old regime, credit was available from local banks.
Yes, and I want us to get into that conversation at some point. But since we have the bankers next to you, and you have accused them of colluding, or earlier colluding before the bill was passed in 2016, I want to get a response from Mr. Gashora to start with.
I think before you go, I was just explaining something.
Yes.
That the loans are not available now for 2 reasons.
Yes.
The bank, the government is borrowing too much. From the banks.
Yes.
So we are competing as wananchi. We are competing with the government on who is to get loan, who is going to get a loan. And of course, the banks will give the first preference to the government because they are certain that the government is going to pay back. So we would ask our government also to limit its borrowing and become more innovative. And I'm happy that the guy who borrows is here.
Honorable Jomo, because it is part of the conversation we're going to have at some point, I'm told John Gashora's microphone is off, so Oigara will take your response.
I just wanted to say the second reason before he fixes his mic. The second reason is because the banks are still together.
They're still colluding.
The banks are still colluding, and they have agreed that they are not going to lend. They are going to cause a credit squeeze so that the government now can come to its side, like it has done, and try to persuade the parliament to remove the interest rate caps. Okay.
Mr. Oigara, are you one of the banks that are colluding?
Well, thank you very much. I think, one thing that we agree, definitely the industry doesn't collude. And I would say 2 things that one issue the industry agrees with Jude is that interest rates were high. There's no doubt about that. The industry has never said the interest rates were low. And I think what CS Rotich mentioned earlier is that there are structural issues we need to address. I personally don't believe that there's one sweep that addresses the issues we're facing on interest rates. And I think that's what we have a difficulty with the current regulation. There are many steps that the industry is facing that we need to address. So some have been identified before. We need to extend the access in terms of how many customers coming in, using more information. But for banks to collude, I will say that if you look at the pricing regime in the industry before the rate, many of our customers, and I want to go to the data that the minister mentioned, only 53% of customers truly were beyond the 14%. There are many customers borrowing below, many customers. And so there couldn't be any collusion. It was what I can call a normal curve. And I think what needs to be done more, and we had what we are welcoming is a conversation happening today to address the specific issues. What I find from our customers that I speak to many times, Terian, which is a big worry, is many customers say they need access to credit today at whatever price. That's what they always say. They have a business to run. And I think banks, people see the numbers because we're regulated and we're among the industry that publishes our results by law. That is a requirement of the Banking Act. There are many businesses that never publish their numbers. If you do, you will see different performance actually that happens. And I think we need to find a way to deal with the high interest rates today rather than dealing with one universal measure to cap every other industry where the credit portfolio risk profile is not addressed. That is the issue that I have a difference with the model. But in
right.
terms of the rates, I think the industry agrees very much with Julia. We need to address the issue of interest rates.
All right, and risk is an issue that we're going to touch on our conversation tonight. Just very quickly before I invite an opinion from the Kenya Association of Manufacturers, Honorable Njomo mentioned, that yes, the interest rate is now affordable, but it is unavailable. And he has accused the banks of colluding once again to ensure that SMEs cannot access this, this financing. What's your opinion on that, Mr. Gashora?
To echo what Josh just said, there's no chance that banks can collude. I think we are perhaps the most regulated industry in this country, and will continue to be. And beyond that, I do want to point out that banks actually adhere to regulation, not just in Kenya, but globally, for the fact that we trade with every bank around the world. Yeah? So we are highly regulated, and therefore colluding would be the last thing we would do. I think the fact is that the Cabinet Secretary talked about the variation in lending that you saw at banks. And that even at a cap of 13.5%, there are customers who are borrowing well below that. So it's not that everybody is 13.5%. But also didn't want to point out something that's, that the statistics have shown, that since the cap, between 2016 and 2017, 1.23 million borrowing customers have stopped borrowing. 1.23 million borrowing customers have stopped borrowing. That's a big number. Beyond that, the average loan amount during that time has grown by 47%. What does that tell us? It tells us the rich and the big companies are continuing to borrow. So what Honorable Jomo wanted to help, the SMEs, the individuals, those are actually the ones that are not borrowing in this market. So for me, it is to think about, I think Honorable and ourselves talk about the same language. We want to help SMEs. We want to make it affordable. We want to make it accessible. If we're talking about SMEs, yet the people, the statistics show, are being wiped out of the market, I think we have to come together and talk about how to move to the next stops, to the next steps, some of which Bukuria talked about.
All right, let's get a business standpoint now from Mr. Gutka. How has access to credit been, for the majority of your members at Kenya Association of Manufacturers? And Mr. Gashora did, Oigara, my apologies, alluded to the fact that a number of people were actually already borrowing below 14%. And, the feeling is that these are people who are big borrowers who could perhaps, fall under your space. So are there smaller enterprises that have not been able to access? Because I guess in that case, the big ones can still negotiate their way around it.
Thank you, Terry-Ann. The KM is made up of actually a majority of the SMEs. And it is true that the big borrowers are borrowing cheaply, and they are borrowing at competitive rates. KM itself, when it financed its own building about three years ago, we got a rate of T-bill, 90-day T-bill plus 3%. So in that time, so it's basically, it is lower than the 14% or 13.5% that we're currently at. So but we were financially strong. The issue is, I asked my board yesterday during the Brazil game on WhatsApp, what are your thoughts? And we have a 17-person board. I would say the answers were pretty much half-half. Half were for retaining the cap, half were for removing it. I would have to come down on the side of removing it, because the access to credit for our SMEs has been really bad. The engine of the economy is the SMEs, the entrepreneurs, and we need them to be able to access credit with which to drive and propel the economy forward. So I would say it has severely stunted their growth projections over the last couple of years. Getting credit, so there's two options. If they want to grow, they will borrow outside the normal banking channels, and they'll borrow at really bad rates, probably in the region of 28 to 36%. And that kind of Shylockian lending is simply not sustainable for a growth economy. Yeah.
On that note of SMEs, I'd like to rope in Anzetse into this conversation. And I know you're passionate about that space, and you've written a number of articles around SMEs and access to credit in this new interest rate regime. Perhaps you could just lend us your thoughts as part of the conversation.
I think broadly, the conversation on interest rate caps is really a conversation about liquidity. And the fact that the majority of the private sector in Kenya, particularly micro, small, and medium enterprise, feels snubbed by the financial sector. That's why it's such an emotive issue, is that we're here, we're doing good business, and yet you guys have these labels that you put on us and you tell us that you're not good enough to get our money. So I think one of the problems with the interest rate cap has been articulated, that it did the opposite. And I was among the first people who were saying that this will lead to a contraction in liquidity, not an expansion. When you start limiting risk ceilings, people get into sort of a very cautious mode, and that's what we've seen. So I think the real concern is that there are two sides of the private sector going on here, as the gentleman alluded to. There are those who are arguing that you must repeal the cap so that we can get the liquidity going again, so that private sector, particularly small and medium enterprise, can get the money. But there are also smaller business players who are saying, no, do not repeal the cap. Because right now, what banks are doing are running to government securities because that's a safe space. But some are arguing that let them run once that saturates, particularly if, as the CS has mentioned, we may go through a phase of fiscal consolidation where we may see a contraction in the amount of borrowing government is going into in the market going forward. If that happens, the smaller players are saying that will saturate and they will have to deal with us. So that is the logic that's going on there as well. I think the other problem that's happening is that this hasn't been going on for long enough for some people. What has happened is that over the past 2 years, over the period of the interest rate cap, the conversation has been primarily driven by the adjustments that banks have been going through, right? In terms of protecting their bottom line and how they're making that happen for them. What we haven't seen, which is my concern, is the extent to which banks are really looking at their risk profiling and their risk modeling to make it more relevant for small and medium enterprise. And I think that's what the conversation Kenyans really want to have is, what is it about micro, small, and medium enterprise that is so risky? And what can both sides of the divide do to bridge that impasse that we're at? Because when you look at small businesses, they're like, whatever we do, they just want collateral. No matter what I try, that is all they want. On the other hand, we have the banks who are saying, listen, your risk profile is something that we're concerned about. So that is the conversation that we need to be having is, if we're not financing 80% of where Kenyans earn a living, then we are neglecting the economy. And until we have that conversation and understand that impasse, then I think, this will continue to be a heated debate that's never resolved.
Kwame, from a think tank, point of view, studying what has happened over the past 2 years, what would your opening statement, vis-a-vis the comments on the panel this evening?
Yeah, I think it's a good thing that we started by, and the Cabinet Secretary mentioned what was the intent of the bill. And Honorable John was mentioned as well what his intentions were. They are also agreed on the fact that it did not have those specific outcomes. So we haven't seen more lending to small and micro enterprises. We haven't seen better rates for savers, and we haven't seen that contraction. So basically, on all the three items for which the rationale for the bill, we haven't achieved that outcome. Now, I think if you start from a legal perspective, laws should not be passed in vain. So let's even start with that. We can leave the economics and the debates aside. Laws should not be passed. So if we pass a law that 2 years later has not achieved what the effect was, we shouldn't say, like, let's dig deeper and wait for it to hurt before we can all do that. It hasn't. On the other side, one of the things that we've done, one of the reasons why it was predictable that wasn't going to happen, government had huge deficits and ongoing deficits. So if I was any banker, and remember that they're also accountable not only to their shareholders, to their boards, it would be responsible to lend to at the risk profile that is risky when you can actually sweep the floor with these coins the government was throwing at you. So unless, and Honorable Jomo said that one of the things that his government is, you shouldn't be saying that you're pleading with the cabinet secretary to lend less. Just ask him to reduce the deficit. And you can do that as a legislator by saying, look, we are not passing this budget unless you squeeze this deficit. And that's your legitimate responsibility. It's constitutional. So in a way, in the same way that you're pointing at banks and telling them, look, stop your collusion, you can also point at the cabinet secretary and say, we are unhappy with the deficit. So my thinking is, and perhaps members of parliament should do, all the responsibilities that the government of Kenya has, and they're huge, can be accomplished for much less than 2.5 trillion shillings. So what you should tell him is that, look, we want you to trim this budget by this amount. Don't give us an incremental budget, which means that if we gave you 1 year 2.7 trillion, then you expect us that in the next year we are going to necessarily raise it. No, we want to see you achieve greater goals with less money. So by that, definitely the lending from the domestic market and externally would have to be squeezed.
All right. Thank you. With that, I'd like Honorable Njomo to give, just a follow-up to that, the issue of deficit and the issue of interest rate, which will, bring us to the same conclusion that we're looking for.
Well, he has made it look like there's no positive effect of the law. The savers are earning more out of the bill because previously they were earning about 3%. Now they are earning 7.5% because of the flow. So people are earning more. It's very, very unfortunate that there are very few people who save. So those few who save are earning more. Two, I think Bernard Rotich has done well this time because he has tried to reduce the deficit. And it's going to have a great effect on our economy. And there are other measures that he has promised to put in place so that there can be better regulated system in the banking industry. But why do we want to remove the caps before those measures have taken place and we have felt the effect? We have suffered a lot under the banks. Why do we want to suffer one more year as we wait for those measures to be put into place? I have a responsibility, just like you said, I had a responsibility in reducing the deficit. I have a responsibility of protecting the people who elected me to parliament to go and make rules and to do oversight for them. So I still feel, yes, we may have to remove the caps, but the time has not come. Right. I remember the CS said we have waited for long enough, but I don't think Mwananchi have waited for long enough. He have suffered for many, many years. The bank continues saying that Mwananchi is a risky lender. And I wonder why. I was Googling the interest rates that are charged by other African banks. And I was shocked that our sisters in Tanzania are being charged 12.14%. And there is no capping in Tanzania. How comes we are so dangerous, much more dangerous than our brothers and sisters in Tanzania?
And I want the CEOs to directly answer that question. We've got both Gashora and Oigara raising their hands.
Sure, can I?
Yeah.
Yeah, let me please comment on that because I think the honorable member has mentioned some numbers, and I think we should put the record straight. That first of all, that we do operate in Tanzania as KCB does in Tanzania. So I know the numbers firsthand. I can assure you that Tanzania today, government borrowing, T-bills, are at 2%, 2 to 3% today. Okay? That is the truth. In Kenya, we're still 8 to 12%. That's a fact. The second thing I would say is lending to companies in Tanzania shillings, the lowest I have seen so far, and Joshua, maybe you're better than I am, in 17%. So I'm curious where you've gone in the 12% from. He also made a statement before saying lending in Kenya was the most expensive in the world at 28%. Yes, it was very high. 28% was very high. And Joshua alluded to the fact that we as banks recognize this. Part of the reason we have not been able to bring it down as banks is because we cannot collude. You've asked us twice whether we can collude. Certainly because we cannot sit in the same room, Joshua and I, and agree, and Jeremy, and agree that we bring rates down. That's collusion. We cannot do that. However, I can assure you that our customers, most of them today, Kenyan customer is multi-banked. At NIC Bank, 85% of our customers have more than one bank account. In other words, they know my rates, they know Joshua's rates, they know someone else's rates. And when they negotiate for rates, they look at those three banks, or more banks, whatever number of banks they have. The honorable member also talked about the fact that the positive effect of this bill has been that the savers have received better returns. Now, I would agree with him. The savers have received better returns. But who are the savers? It's the people you see on this stage. It's the rich people. Are they the people we're trying to address today? We're talking about the SMEs. We're talking about the small borrowers out there. So whereas there are positives, obviously, to this rate cap law, as you said before, those who are able to access are accessing at a much affordable rate. Unfortunately, it has locked out the majority of the people we want to help. Okay. As I said, 1.23 million accounts have stopped borrowing.
Well, Gareth?
Yes, I mean, I think I want to just add one issue that Jude raised. I mean, it's just to make it a conversation, and also what Ansete said earlier. It's important to see the trend. What is the challenge I have with this conversation is that we want to cut it deep today and stop. If you look at the rates before, in 2015, rates were as high as 25%. In fact, when Treasury borrowing was at the all-time high, rates went up. And then rates started coming down from before the rate cap came in. You have to see it as a journey, it's a continuum. I mean, many times I see customers ask me and say, we want to borrow at LIBOR plus 2. So assuming LIBOR is 3%, plus 2 is 5%, they want to borrow as London. I want to borrow as great as UK. I ask my customers, but which market are we? I mean, it's like, I ask them, what is the price of their train ticket in London versus a matatu in Nairobi? Because you're going to benchmark, each market has its own fundamentals. Now, banking, we can say is an art. The price of credit is a science. You need to say, what are the risks you're facing today? And I was raising an issue and said earlier to say, it's not that banks don't lend to SMEs. That's not really the question. I think if you look at the last 10 years, today, 24% of our lending overall is small enterprises. It was 10% 7 years ago. Banks are making, as you build in more data, as you're getting more, because remember, at the end of the day, you're deploying resources into a risk environment. That's what banking does, and the customers expect deposits. So other than banks cannot be reckless to put deposit and savings into money where you can't get returns from. So KBA looks at this issue and says, so I was expecting from the work we are doing with the National Treasury, collateral sharing, single registry, cost for you even just to securitize the documents, making it easier, legal fee that we enforce. We were saying by 2020, we are going to see access to SMEs going to 30%, 40%. That's what National Treasury is doing ourselves as an industry. So I would say it's a journey. Now, there's a discomfort today. But I always say to Jude, if you look at savings per capita, which is important to look at data, 3 trillion is our savings in the industry, 30 million customers. If you do a simple math, it means as depositors got 100 million. How many Kenyans today have 100 million as a savings? And this is what John said earlier, that we need to be able to find out that how do we encourage savings? Without savings, India today is at 38%. Savings. Malaysia today is at 40%. These are data you can find out from the World Bank. We ourselves are struggling at 11%. Now, without savings, we all struggle. And this is a bigger challenge we need to find out. And then we were looking at the mechanisms either through the agendas we have. So I wanted to say that in the region, and I can put on record on the region, because we are in every country, Kenya still has the lowest interest rates today. Neither Rwanda, neither Uganda, neither Tanzania, neither the difficult country like in South Sudan, neither of them. The only country that we seem to be comparing ourselves now to is South Africa, which is around about 7-8%, and to sometimes 10% in local currency, and Nigeria. So, and those economies have specific parameters. What I will wish to do for our customers, and why we are pushing for this, is not to get away, and perhaps we need to look beyond this. What can be done to deal with the risk if the amendment is made? Because there's no confidence, there's no trust that the banks will do the right thing. Maybe that's what we should discuss and say, what more mechanisms are there to enforce a conduct within the industry, within the sector, that can ensure that customers don't get exploited. Things like usury, that's what perhaps we need to look at, because in my view, I believe that I want to lend to that customer today who actually, you asked me a very good question about what do we do with our risk model. It's a science. We have models, risk buckets. Because of the pricing cap, many customers can no longer qualify to be able to get credit. So they ask me.
But is there opening,
Yes.
or does that provide a space to have a negotiation or to have a conversation about how the banks actually, measure the risk profile of SMEs?
There's also a notion that is being created that SMEs are not accessing loan. That is what these two bankers have said. And I would like to correct their language and tell them, you say, we are not giving SMEs loan.
Okay. And I would like them to directly respond to that. Are you giving SMEs loans?
Let me comment on that. First of all, I want to be very clear. Banks make money when they lend. We have no other business.
But you're lending to
We
government.
make money, let me just finish. We make money by lending. So we have the biggest incentive, more than politicians, more than anyone else, to lend to everybody who walks through the door. Because that's how we make money. That's our business. Given that, the money we lend is the depositors' money. These people who are getting those 7% rates of deposits, that's the money we lend. And we have to make sure that they are able to come for that money when they need it. It's available. So we must weigh those risks very carefully. Today's numbers, let me just read some numbers out. If you look at the non-performing loan book today within the banks, it's around 12%. It's around 12%. Okay, that means, in simple terms, for every 100 people you lend, 11 or 12 of them will not repay their loan. Okay, that's the number. If you go down to SMEs, that number goes up a bit more. And if you go down to personal, which means individuals, that number approaches 20%. These are the numbers we're dealing with. So you're telling me that a bank should lend to SMEs with a default rate of, say, 15% and charge 13%. They will not even be able to recover their money that they lent. In other words, when Mheshimiwa comes back for his deposit, I'll not have it because I lent it out and I cannot collect it. That is the analysis that we do. And we go through that every single day.
All right. Let's move on a little bit and into the structural issues that need to be redressed, where the cost of credit in Kenya is concerned for it to be reduced. And I want to start with Kwame on this particular issue because, there seems to be a common consensus that, yes, there is a problem, specifically where the SMEs are concerned. What are some of the structural issues, that can be used? And as you ponder on that for a minute, I want the bankers to think about some of the solutions that you had proposed in 2016, saying, we'll come together and form an SME fund of, X billion shillings, which hasn't been, which SMEs, would come and get money from at a certain interest rate. But that hasn't happened. So as Kwame responds to that, I will be waiting for response to some of the structural issues.
Okay, Terian, your question, half of the answer comes from what a previous speaker mentioned, which is SMEs might be a global name for a number of institutions, but their risk profile is not the same. So some are more risky than others. If that 100 shillings was to be determined, and Joshua, his colleague, was determining who to give it to, they have to make an analysis about who would I lend this money to and ensure that after every quarter or every month or whatever our contract is, I'd be able to collect that money at the lowest, with the lowest costs. So basically, because they have to do that analysis and splitting, it's clear to them that a business with a track record or one that they've dealt with over time is a far better or stands a far better chance of repaying them than somebody else. Mm-hmm. So when we say that we are trying to push all SMEs to be provided with credit, we are actually asking that the default rates go up and increasing the systemic risk within the banking sector altogether. I think what we must, the gentleman can't say it because it's impolite or impolitic, but it's true. Not every person who comes to knock at the door of a banker deserves to be lent money. And the difficult decision they have to make, given the profile in the country, is to decide which people are more creditworthy than others. Remember, the money that they have is not an unlimited supply. So obviously they have to make and choose here. So when you say that, I think the structural question is, we have too many small firms. Fine, all of them are doing well, but the fact that you actually have to dissect and find out who's deserving of this money and how much should we give them and how much funds are available to us as well to be able to provide. It's not an easy job. Yeah. Banks suffer from them, or rather, banks face them or deal with them in terms of the backflow. Okay. So if you're not dealing with that, you can't shrink it beyond what they can do.
You have some other just one additional point. You know, you've got small, medium, and micro enterprises that are always put together as SMEs, which I think for me is absolutely not the right way to look at it. Every single customer's got their own profile. But some customers, what has happened is in that bucket, some micro enterprises are no longer getting credit. Mm. So what we need to do, and this is what I like what the CS has proposed, is an element to deal with a guarantee program, because sometimes it's not really the question about how much the risk. How do you share the risk? It's a risk-sharing model. And Terian, in this case, what you've seen in most markets, even what we thought about as industry in the Inuka Fund we are setting up, is a partial guarantee program in terms of developing a competency to help. Because even a small enterprise, if I start today, Terian, and one of my biggest challenges I have with when I meet with young students, they say, I want to start a business today and become like come senior member tomorrow. Mm. It takes time to build competency, to know your customer profile, deal with relationship, and that's what Inuka Fund was, a program we were targeting 1%. Now, that was just before the cap, 1% of our total portfolio, which was, at that time, it was $30 billion. So it was 1% of that. But then the interest rate came in, and we were not able to roll it out. But I would say that, and it's good for facts to be given, we see a number of SMEs still getting credit, even today, largely because they have matured in their profile, their risk criteria has been much less, and they're growing. You see some of them in transport sector. Some of them were unfortunately affected because they delivered products to government. You see a lot of banks auctioning trucks. John and I, we've auctioned trucks all the time, vehicles. They were good customers. They delivered their goods. No one paid them. And that also became a complication after the interest rates came in. So I would say, Terian, that for us, if that program runs, which we still have in place actually, so the banks have said, despite the interest rate coming, we still want to implement it. And that's something that John and the entire industry is progressing to make sure it is applicable, effective. So that will have reached almost 400 billion shillings, which is a significant amount for those enterprises.
Absolutely. And Zetson?
I think the broader conversation that we are not talking about is that what the banks are talking about is that they don't really have a pipeline of credible micro, small, and medium enterprises to which they can lend. And I think that's what's missing in this whole conversation. So the gentleman MP has made the point that a lot of micro, small, and medium enterprises are viewed as high risk, etc. What we're not solving is a step before, which is what is the type of financing that needs to be quite creative. And the other problem I have with this conversation is that it's as though all the micro, small enterprises need is money. There's a whole ecosystem and deployment of support that they require to reach a stage to graduate and graduate into a pipeline. So I think one of the things that we need to do is do the initiatives such as the CS says, whereas government has to play a fundamental role in creating an environment that allows that pipeline to develop. So you have a role of government financing to come in at below market rate to help them. And not only that, you need an ecosystem of support, but you can also bring in development finance institutions, you can bring in impact investments. What I'm not seeing is people solving the problem of how do we get a bouquet of services to micro, small, and medium enterprise at different phases, because as we know, we're not lumping them all together. What type of financing do they need, and how do we graduate them into debt? Because this is the conversation people are not having, is that there are a lot of people who are running businesses in the informal economy, particularly the micro space, that are not necessarily ready for debt. And we need to start getting people graduating into that process. So if we don't have that conversation, people talk about risk profile until the cows come home.
All right. Kashora?
Just to add to what she said, and maybe to counter what she said, actually. KBA spent a lot of time during the debate, in the earlier phase of this debate, talking about exactly those things you talked about, which is, what is it that SMEs actually need to access, and to access credit? And what we concluded is exactly what you said. It's not just the money. There's a lot more. And I think you asked us about what we proposed. Beyond the 30 billion that we proposed to lend at subsidized rates to SMEs, we set up a fund, or we proposed a fund that would be used to educate, to support these SMEs towards getting them ready to talk to banks, because sometimes they actually don't even have the capacity to talk to banks. So we actually have a program, the Inuka Trust, the Inuka Fund, whose sole purpose is to educate, support these micro and SME companies to get to a level where they can approach a bank, be bankable. And once they become bankable, then they can come to the table to talk about interest rates, and we're willing to negotiate on that basis.
All right. Mr. Gutka?
I think when players in industry start behaving badly, a sledgehammer approach is needed. It happened through your legislation because the delta between the deposit rate and the lending rate was just unconscionably high. And this is simply not sustainable for us to develop as an economy. And I think the banks kept getting signals after signals after signals from government, do something, and they didn't. So the sledgehammer approach was used. It has probably served its purpose. The second issue which Joshua talked about was prompt payment. This is a disease. Government pays late, private sector pays each other late. Everyone, we've just gotten into the culture of paying late. And the retailers, again, need some sort of sledgehammer approach because they have driven payments in this sector, which has had a vicious effect across the industry, and it's led to increased working capital requirements and led to increased cost ultimately to the final consumer. In Asia, in 2002, there was something called the Efficient Consumer Response Mechanism was set up. And KM is looking to spearhead this with a view to bringing in manufacturers, supply chain, and players in the private sector working in a concerted manner to ultimately say, how can we bring the cost of goods down by, say, 25% over a 5 or 6 year period? You work on your competitiveness issues, you drive it down, and you do it in a proper manner. And I think the banking sector probably also needs to do this because 14% for us, is this something that's sustainable for us to really grow the economy and achieve the Big Four agenda within the 4 year period? When Jomo is saying, let's wait a year, if we are to deliver the Big Four agenda, I think waiting a year is not going to drive the propulsion of lending into the sector and the activities to take off. So is something needed now? I guess it is to spearhead the revival of lending to sectors.
All right, I'd like to, I mentioned earlier that this would be...
Just like an issue for you, which is, I think it's important for viewers to see. In many times, what the Senator said is actually right. That banks, we need to expand. So industry is looking at expanding the different sources of financing for businesses. Because banks always take the blunt today and say, you're the only one. But largely, even as we are working with the capital markets, the National Treasury, the seed funds coming in from venture capitalists into the market, because that's how you actually put their business coming to the bank today, that if you give them debt, they will fail tomorrow. You see that a lot of times. Now, a lot of if you look at private equity here, most of the funds is coming from South Africa. And I like what Jude raised and what the Member of Parliament raised earlier. Pension funds, like in South Africa, are large investors in private equity in our markets here. But we don't get a chance to deploy those resources to bring in long-term low-cost funds into the market of financing in like SMEs. We never do it. What do pension funds do? Actually, the trustees are very nervous to take a risk on a business. If you ask a trustee to lend to a small business, they wouldn't be able to do it. And I think we need a mismatch of the two. So that's why I like the collaborative. So the time is right to bring in Jude, to bring in the minister and everybody else, to have win-win solution. That's, for me, is the debate we need to be having, because one way or one streak or mark won't be able to address our fundamental problem, even with a cap.
All right.
Terian, I'm amazed at how our banks now have become, very good advisors on Kenyan economy, and they are doing very well at that. But when we were doing this law, they had refused to come and give their views to the committees that were involved. We had to write to the Kenya Bankers Association for them to come and give us their contribution. And I am sure if you go and check out, in that one year, in the second year of when the rates were capped, you look at the profitability of the banks, what they made, and they all made an increment. It may be a small increment, but the increment was there. And remember, it was an election year. There was political turmoil, but they continued to make profit. So all this sugar-coated advice we are getting about economy.
Sugar-coated. Let's give them a right of reply. Gashora, let's start with you.
I would like to believe that this debate was never about bank profitability. I like to believe that we talked about the interest rate cap, again, in the interest of the borrower, in the interest of the depositor, never the interest of reducing bank profitability. I came on record then, and I think you actually interviewed me then in your previous position, where I said very clearly that banks will continue to make profits. That's what I said then. I'll say it again. Banks will continue to make profits. We're in the business. Like every business, you adjust with the times. So it should never be. I think we should take away that debate of bank profitability. But on that, I would like to say this. No country ever developed without strong banking institutions. If you're looking to get to Vision 2030, one area we must focus on is making sure that we have a very strong financial system, very strong banking systems. If you look at America, the history of the Lehman Brothers, the history of JP Morgan, if you look at Europe, the history of the Rothschild and what they did for those countries, that is what develops a nation. So let us not be afraid to have big banks. That should not be the problem. Let's be more afraid to have big banks that are lending only to the government because of a rate cap.
All right. I'd like to rope in members of...
It's important to appreciate the industry. And I would say one thing for them. Actually, you've got a sector that has got the knowledge and the capability to deliver credit to customers who qualify. It's just like a manufacturer. I mean, there's no other person today that will know how to deliver credit today, globally, than a financial institution. I can guarantee you. Right. We don't challenge them. The question is, how do we enable them to be able to deliver with other mechanisms? Right. This is what we really miss today. But to say that banks don't know, I'm not sure there's another person today that has got the metrics, the models, the abilities to be able to do it, not just in Kenya, by the way, globally. All right, allow me. I did say this is going to be a dialogue, and if we do not allow our audience, then I'll have to change my intro altogether. Japheth Ogutu, you have a question. Please stand up and introduce yourself and direct your question to whichever member of the panel that you want to speak with.
My name is Japheth Ogutu. I'm the Executive Director at the Consumer Downtown Association. Consumer Downtown Association is one of the consumer protection organizations in the country. We stand in for the interests of consumers in the country. And I'm very grateful to be here because there are very important issues that we needed to actually discuss with banks. One, I will begin by saying that what really motivates consumer actually to operate a bank account or with a bank. There are very key issues. One, I would want to save perhaps to get some income later, or interest later, or rather some profit. I would also want to operate an account with bank, for instance, to access loan, or maybe to get some other services like mortgage and other attractive products that are available. But I'm not saying that we will fully support this. There must be very clear measures to ensure we first tame the behavior of banks. I want to reiterate and
all right, thank you.
What Mheshimiwa said. Let us have the measures first.
Yes.
Then once we have the measures that we are sure that we are not going to be looted, then we can now transit into banking, into the capping.
All right, I guess an issue of trust where banks is concerned, and how do we believe that even if this interest rate cap is lifted, that you will behave in a manner which, Kenyans would want you to. With that, I'd like to have a very quick comment as a way forward from all our panelists. Where to now? Let's start with you, Kwame.
Okay, I think we've come full circle in the sense that we tried to solve a problem, we've come back. I concede, yes, that there's more, if you're saving, then you obviously have more, you have a greater return on your saving than you'd have had before. But the two other things that are important, pushing out credit, specifically to SMEs, has not happened, or at least it's not satisfactory. So it's clear to me that we actually can ask ourselves, if there's a structural issue, we think there's insufficient competition within banking, and I'm not too sure there isn't, then maybe what we need to ask ourselves is this law the way to where we want it to go to? It certainly is not. I think also we must avoid the idea that we must give in something, or rather we must look like we are punishing banks to make sure that the cap is reduced. I am persuaded that there's an element, there's a lot that the government can actually do, quote unquote, to make banks not have to go for the lowest hanging fruit.
All right.
And to be more innovative in the way that they lend.
All right, thank you. And Zetse?
I just think, obviously, for me, the real issue is the micro, small, and medium enterprise, and really getting an ecosystem of support to help them graduate into debt. I think that's the first thing. I think the other thing is looking at the fiscal deficit and looking at fiscal policy and really getting into a phase of fiscal consolidation, so that we are working together. Government is doing its bit, banks are doing its bit, but we're also working with the micro, small, and medium enterprises so they don't feel as neglected as they have been. So I think until that is resolved, this push and pull will continue.
All right. Ogara?
Yes, first, I must appreciate that we have a broad conversation. So obviously, Moses Kuria, who raised this conversation, and Jude, I think it's important. This wasn't actually happening even at the time the cap came in. Banks had many proposals, but you know, I think Jude was around. We never got a chance to have this engagement. So it's a broader conversation which we need to have ourselves. And my view is that as long as we see the sign of where the direction of in terms of the issues we are dealing with, and some of them are looking at the 12-point actions that the minister had in 2016 on addressing the cost of credit. Most of them are actually being put in place. It's just that they were overtaken by the interest rate cap. And lastly, we have to completely isolate the policy rate, the CBR rate, as a basis of writing credit. It has absolutely no relationship at all. And that has been, I said earlier what Mohamed said, that today, banks could be lending today at 7%. Could be lending today. But they could not be able to do it today because we are locked into a monetary policy instrument. I mean, that's an issue that even in this amendment, even if we get nothing else, that needs to be revisited to allow banks to price themselves based on different instruments for the cost of credit.
All right, thank you. Jude?
I would like to allay fears that we as legislators did this to punish the banks. That was very far from our mind. And what we had in mind was to have an industry that is disciplined, an industry that in itself is also not punishing our people. We are still not convinced that the time has come to change this law and remove the interest cap rates.
All right, and some people say the other reason is that members of parliament are also some of the biggest borrowers who can access credit at such rates.
Everybody borrows.
All right, Mr. Gashora?
I think it's very clear that there was a very good basis for which this law came from. The emotions, the fact that the banks had misbehaved, the banks were not listening to their customers. And I think hopefully everybody recognizes that the banks have recognized their mistakes, and we are aware of why this law was supported so broadly. What is also clear is that even though we seem to be arguing on this panel, there is full agreement that at the end of the day, we all want to address that borrower, that SME. Honorable Jude Jomo has talked about his voters, his SMEs, his Wanjikos, and those are the people that he wants to support. Those are the same people that we want to support.
Mr. Gupta?
I think the importance of injecting velocity and liquidity into the economy cannot be understated. So this economy needs the lubrication, needs the liquidity injected quickly for us to reach the ambitious targets set. I think Joshua mentioned about the UK banking system. There are probably 10 to 15 million mortgage holders in the UK, or mortgage accounts. We have less than 35,000 mortgage accounts in Kenya. Absolutely pitiful.
Thank you so much. To all our viewers here and at home, thank you so much for being part of this conversation. And this conversation continues online on Fanaka Digital and the Kenya Bankers handle as well. Well, let's meet again at the next debate, only on Fanaka TV, and we say we are strictly business. Have a good night.